In Chapter 13, we looked at how the budget can be used to plan for the future and to communicate our expectations to various departments or divisions within our organization. In Chapter 16, we will be looking at how the budget can be used for control. That is, we want to be able to compare what we expected to happen and what actually happened and determine why things might not have worked out exactly the way we planned and what that means for the future. In order to do this, we need to compare our actual results to our budgeted results. That's called a budget variance. We use this information to monitor operations to see whether things are working out the way that we expected them to. We also use this information to motivate people within our organization. Here's what we expect you to do. Let's see if it comes out that way. Budget variances may be either favorable or unfavorable. A favorable budget variance means either that our revenues were higher than we expected them to be, or our costs were lower than we expected. Unfavorable budget variances mean either that our revenues were lower than we expected or our costs were higher. But don't confuse favorable with good or unfavorable with bad. Whether a particular variance is good news or bad news for our firm depends on its relationship to other factors within the firm. So what do these variances tell us? Well, they might tell us about inefficiencies within the firm, and we would want to know that so that we can take appropriate managerial action to fix them. Alternatively, it may turn out that things worked better than we expected. In that case, we'd like to know about it so that we can make sure to continue that activity and maybe extend it to other areas of our operations. Alternatively, a variance might tell us something has changed that we did not know about when we made this budget. We need that information so that we can incorporate it into our budgeting going forward. One of the basic rules of cost accounting is that you cannot control costs that you can't see. Part of the goal of variance analysis is to make differences between what we expected and what actually happened visible so that we can decide what we would like to do about them going forward. Let's take a look at Tina's trinkets. Tina is making a budget for next month. She expects that she will be able to sell 1,100 units. At a budgeted selling price of $10 per unit, she can compute her budgeted sales revenue. She expects her variable cost per unit to be $3 times 1,100 units gives Tina her total variable cost. The difference between her budgeted revenue and her budgeted variable costs is her budgeted contribution margin minus her budgeted fixed cost gives her budgeted operating income for the period. before the period starts, this would be called a master budget. After the period is over, that same budget is called the static budget because it was prepared before the period ever started at the expected level of activity. Now let's take a look at what actually happened during the period. When we compare the static budget to actual results, that gives us what's called a static budget variance. And it does not matter which number we subtract from the other number. What matters is whether it is favorable or unfavorable. So during the period, Tina actually sold 980 units, whereas she had expected to sell 1,100. That gives her an unfavorable static budget variance of 120 units. When she compares her budgeted revenue to her actual revenue, she finds she generated less revenue than expected, and the difference is an unfavorable variance. On the other hand, she finds that her variable costs were less than expected. That gives her a favorable static budget variance for variable costs. Tina's static budget variance for her contribution margin can be computed two ways, either by comparing the variance for her revenues to the variance for her variable costs, or by comparing the contribution margin on the static budget to the contribution margin in her actual results. She can also compute her static budget variance for fixed costs. Her fixed costs were actually less than she budgeted. That's favorable. And she can compute a variance for operating income, either by subtracting the variance for fixed costs from the variance for contribution margin, or by comparing the static budget operating income to her actual income. Based on this analysis, how does the firm seem to be doing? Well, we noticed that we had favorable variances for fixed costs and variable costs. That seems good. On the other hand, we had unfavorable variances for revenue, contribution margin, and operating income. Altogether, doesn't sound like good news. What might be wrong with this analysis? It could be right here. Her static budget was based on an expectation that she would sell 1,100 units, but that's not what happened. She actually sold 980 units. That means, in terms of understanding this month's operations, the static budget was made at the wrong level of activity. We did not know that at the time. We made the best estimate that we could, but it turns out that we actually operated at a different level of activity. That means the static budget is not a fair basis for comparison. The way to solve this problem is to compute a flexible budget at the actual level of activity. In other words, if we had known before the period started how busy we were going to be, what would the budget have looked like? Well, if we had known that we were going to sell 980 units, that means now we have no variance in terms of the number of units. That means the flexible budget is prepared at the appropriate level of activity for comparing with our actual results during this period. In that case, we would have budgeted 980 units times $10 a unit to get our sales revenue. In that case, we actually have an unfavorable flexible budget variance for revenue because our actual revenue was less than what we would have expected for 980 units. For variable costs, we would have budgeted $3 a unit times 980 units, and it turns out we actually spent a little more than that, unfavorable. Our contribution margin we can compute as the difference between our budgeted revenue and our budgeted variable costs at the actual level of activity. And we find we have an unfavorable flexible budget variance for contribution margin as well. What about fixed costs? We had budgeted $5,000, and we don't expect fixed costs to change because we made a few more units or a few less units, so that would not change in the flexible budget, and actual results indicate that we spent less than we expected for our fixed costs. We can compute our flexible budget operating income for the period, and we can also compute our flexible budget variance for operating income either by comparing the unfavorable contribution margin variance with the favorable fixed cost variance, or by comparing our actual operating income to our flexible budget operating income. Based on this analysis, how is Tina's Trinkets doing this month? Well, we have an unfavorable variance for revenues. That means since the flexible budget was prepared for 980 units and reality was 980 units, Tina cannot have sold all of her units for an average price of $10. She must have marked some of them down. She must have sold them for less. Furthermore, we had a small unfavorable variance for variable cost. That means she must have paid more than $3 per unit on average for her variable costs. And the only reason that she ended up with a favorable variance for operating income was that she had a significant favorable variance for fixed costs. In other words, some of her fixed costs turned out to be less than she expected. Her rent didn't go up the way she had expected, or taxes didn't go up, or some other fixed cost item was not as high as she had budgeted. This analysis, this flexible budget variance, is significantly different from the static budget variances that we saw in the previous slide. Comparing actual results to the static budget will never result in a good understanding of what happened during the period if the static budget was prepared for a different level of activity. The only way to understand what happened during the period is to recompute a flexible budget at the actual level of activity. There is another use for flexible budgets. Some firms compute flexible budgets before the period starts over a range of activity levels. This is a form of sensitivity analysis or what if analysis. What if our sales were 10% higher, 20% higher, 15% lower? What would that do to our profitability during the period? Let's take a look at a practice problem. A firm expected to make and sell 15,000 units. It has information in the master budget, including $450,000 of variable cost and $350,000 of fixed costs. The actual volume during the period is 12,000 units. What would their flexible budget look like for their costs at the actual level of activity? Let's take a look at the solution. Their budgeted variable cost must be the $450,000 total variable cost divided by the number of units that they expected to make. That means their expectation is $30 per unit for variable cost. At 12,000 units, that means their budgeted variable cost at the actual level of activity would be $360,000. Fixed costs are not expected to change with a change in the activity level, so we would budget that would be $350,000 at either level. Add the total variable and fixed cost, and we would say that the flexible budget at the actual level of activity is $710,000. Another issue that relates to budget variances is the use of standard costing. Standard costing is a way of incorporating budget variances into our accounting records. Firms that use standard costing determine a standard price and a standard quantity for all production inputs before the period ever starts. So the standard cost for a particular input is going to be the standard price times the standard quantity. Then the firm is in a good position to compare the actual results to the flexible budget to determine budget variances. That will enable us to determine things that went unusually well, things that we would like to happen again next period, and to identify things that didn't work out as well as we had hoped and find ways to reduce or eliminate those problems going forward, and finally to check to see whether our standards are reasonable. There are two sources of variances on any cost item. One source is paying a different amount than we expected, and the other source is using a different amount than we expected. So we can say that our cost variance for any item between what we expected it would cost and what it actually cost is the sum of the price variance, how much dollar difference did it make that we paid a different amount than we had budgeted, plus the efficiency variance. How much dollar difference did it make that we used a different amount of that input than we expected? We'll take a look at how to compute these variances in Part B of Chapter 16.